Hey everybody, Eric Engebretson here, and there's been a bunch of chatter out on the internet about the government raising rates for good buyers and lowering rates for bad buyers. So I got two calls on this yesterday, so I figured I would make a video and kind of just bring some clarity to the situation. So Fannie Mae and Freddie Mac are regulated by the FHFA. And that is the regulator that's across pretty much the entire mortgage industry. VA, FHA, Fannie Mae, Freddie Mac. They regulate all four of those entities. They make up about 95% of all originated mortgages in the United States. So this regulators, their mission is to promote home ownership for Americans. That's been their mission going all the way back to, I think, the 50s when this was originally created. The head of the FHFA is appointed by the president, so there is some political side to this. But it's important to note that this initial announcement was made in early January about how they were changing some of what they call the loan level price adjustments, or risk-based pricing, as I like to call it. So basically, the more risk you have, the higher the rate, because you're a riskier loan, your likelihood of default is higher. The less risk you are, the better rate you get because your level of default is lower. All that makes sense, right? So what they did is they changed the adjusters. So you have your base rate and then they either adjust it down or up depending on your situation, the house you're buying, how much you're putting down, and your credit scores. So what happened is for the people that have the higher credit scores and are putting larger down payments, some of those positive adjusters got slightly worse, or they added adjusters to their the risk-based pricing on how they price the interest rate. For people that put less down and have more marginal credit, the negative adjusters improved a little bit. So they're not that they got benefited, they just made the penalty less, right? They penalized them less. So the spread between let's say an A plus buyer, very low risk, and a C buyer, higher risk, that spread got a little closer, right? So that's what happened. But what I think a lot of some of these, TikTok videos and these short little clips are saying is that now the people with marginal credit and low down payments get better rates than the people with better credit and larger down payments. And that couldn't be farther from the truth. What is happening in reality is that spread got less. So if you have really good credit, you have a large amount to put down, you're still getting the best rate in the market. And if you have marginal credit and you are putting less down, you're just getting a little bit better interest rate, but you're still paying higher rates than you would if you had good credit or a larger down payment. So certainly don't miss your car payment and try to come get a better mortgage, because that is bad idea. See you guys soon.